If you pull up your brokerage statement right now, you might just see a ghost. You know the one I'm talking about? Maybe it's Rite or Bed Bath & Beyond, a stock that shows a value of 0, or maybe fractions of a penny. It's just sitting there, kind of mocking you, right? You can't sell it, so you figure you can't claim the loss. Well, after doing a deep forensic dive into the IRS tax code, I'm here to tell you there is a specific approved way to declare that investment officially gone and turn that phantom loss into a real tax deduction. So today, we're going to clean up your portfolio. Here's our game plan. First, we'll identify that ghost in your portfolio. Second, we'll get into what the IRS calls the wholly worthless test. Third, I'll show you the secret weapon, the abandonment solution. Fourth, we'll turn that loss into a valuable tax coupon. And finally, you'll learn about an incredible 7-year time machine for losses you might have missed. All right, let's start with the problem itself. It's that zombie asset, that one holding that just haunts your statement. It's a constant reminder of an investment that, well, it didn't pan out. We've all been there. But because you can't sell it, you feel like your hands are tied. You're essentially caught in a classic catch-22. We all learn that to claim a loss, you have to sell the stock. But how do you sell something that nobody wants to buy? It's this frustrating little loop that keeps that money locked up and useless. But I promise you, it is not a dead end. And that feeling of frustration, it's completely normal. But here's the good news. That dead money isn't a lost cause. There is a very clear IRS-approved path forward to recover its value, and we're going to walk down that path right now. Okay, now for the interesting part, the rules of the game. The IRS is incredibly specific about this stuff, and understanding their exact language is the key that unlocks this entire strategy. This is the single most important rule to get right. If a stock you bought for $100 is now worth a penny, you can't deduct that loss, not yet. The IRS just sees that as a paper loss. To claim the deduction, the stock has to be, in their words, wholly worthless. Think of it this way. A big price drop means the stock is on life support. Wholly worthless means it's been declared legally dead. We need that death certificate. So how do you get that official death certificate? Well, you can't just decide it's worthless yourself. The IRS needs proof. They need what's called an identifiable event, a specific, concrete moment in time that proves the stock is gone for good. So what counts? The two big ones are a Chapter 7 bankruptcy, liquidation. That's when the company closes its doors for good and sells off everything. Or a court order that specifically says the shares are canceled. Now here's a really important warning. A Chapter 11 bankruptcy is usually not enough. That's just a reorganization. The company might survive, so the IRS says you have to wait. Okay, but what about those stocks that are stuck in that zombie limbo? They aren't officially liquidated, but they're not coming back either. This is where your secret weapon comes in. And this is where almost everyone gets stuck and gives up. The stock is a zombie, it's been delisted, maybe it trades for 1/1000th of a penny on some obscure market. Selling it would cost way more in commissions than it's worth. You feel completely trapped. So, what can you do? Well, here is the brilliant solution, and it's right there in the tax code. It's called the Abandonment Doctrine. This is a powerful but little-known rule that lets you take control. You don't have to wait for a bankruptcy court. You can create your own identifiable event. And the process is actually pretty simple. You just have to contact your broker, your Fidelity, your Schwab, wherever, and tell them you want to abandon the security. They often have a form for this, sometimes called a worthless security removal or liquidate for zero form. The key is you have to give up all your rights to the stock, and you can't receive a single penny for it. It has to be a transaction for $0. That action creates the paper trail, the trade confirmation, showing a sale for $0.00 that the IRS needs. So you've done it. You've officially abandoned the stock. Now it's time for the payoff. And I want you to completely change how you think about this. It's no longer a financial loss. It's now a valuable tax coupon. The paperwork might seem like the tricky part, but it's not. Here's exactly how to report it on IRS Form 8949. In the description column, you just write the stock's name and add the word worthless. For the date sold, here's a little trick. The IRS says you always use the last day of the year, December 31st. Proceeds are 0, and your cost basis is just what you originally paid for the stock. That's it. And just like that, you've magically transformed a completely useless asset into a powerful financial tool. It's like a gift card from the IRS. And the best part is, this gift card never, ever expires. So how do you spend it? Well, it has 3 powerful uses. First, it completely wipes out any other capital gains you might have, dollar for dollar.
So if you sold a winning stock, this loss can make those profits tax-free. If you still have losses left over, you can use up to $3,000 to lower your ordinary income, from your pension, interest, whatever. And if the loss was huge, you just carry the rest over to next year and the year after that, until it's all gone. Let's just focus on that $3,000 number for a second. That is so powerful. It's a direct reduction of your taxable income. You can use it year after year after year to lower your tax bill until that entire loss has been used up.
And here's a pro tip where you can get really strategic. That $3,000 income reduction might do double duty. For many seniors, lowering your income, even by just a little bit, could be what keeps you under the income threshold to qualify for other big tax breaks, like that new senior standard deduction. It's a fantastic 2-for-1 benefit. All right, I saved one of the best pieces of news for last. This is what I call the 7-year time machine. And this is for anybody out there thinking, gosh, I wish I had known about this years ago. Well, listen up. 7 years. That's the magic number. The IRS gives you an incredibly long 7-year window to go back and claim a refund for a worthless stock you forgot about. This isn't the normal rule. It's a special exception just for this situation. It comes from a special part of the tax code. And the reason for it is pretty simple. The IRS understands that it can be tough to know the exact year a security became worthless. So instead of the normal 3-year window to amend a tax return, for this, they give you 7. So think about what that means. You could have a stock that went to 0 years ago. You never claimed the loss. You can still go back, file an amended return that's Form 1040X, and potentially get a refund check in the mail from the IRS. That's not just a future deduction. That's actual cash back in your pocket. Look, I want to end on this note. Claiming this deduction is not about admitting you made a bad investment. Every single investor, even the greats, pick stocks that don't work out. This is about being a smart, savvy manager of your own money. You're not admitting defeat. You're executing a recovery operation. So the only question you need to ask yourself is this. What dead money is hiding in your portfolio right now, just waiting for you to turn it back into a live, valuable asset? It's time to go find out.